Hello, this is my first ever video tutorial that complements the SparkHub podcast. I get asked a lot about money and how money works, and I've helped female friends and male friends and married friends and divorced friends kind of understand how they can maximize cash flow. Now, the key word here is flow. So I've put together a little presentation, and it would probably help me out if this was living somewhere online and people could consult it. But in this presentation, I want to just talk to you about how money flows and how you can make different arrangements within your life to help your money flow. All this video is here to do is help you think about money flow, cash flow. And then if you want to go a level down and get into the nitty-gritty, that's where you're going to need professional advice. So this video is related to SparkHub episode 30. Maybe you've heard it, maybe you haven't. But what I've done is in the links below the video, there's a link back to the episode, but there's also a link to this presentation you're about to see, which allows you to kind of go through it at your own pace. And at the end, there's a summary table, which I'll come to in a second, which I hope is helpful to you. So let's talk about money flow. All right, I think if I've done my job right, my face should have disappeared so we can focus on what's happening. So to begin with, this is typically how finance works, spreadsheets, right? Well, today we're not going to talk about that. I want you to think about money and cash in terms of water. So we're not going to use any numbers. Please note, I'm not a professional. I'm just telling you a story. Always operate within your means. Always minimize risk, especially if you have children. Definitely seek professional advice specific to your circumstances and always pay your taxes. So with that out of the way, think about money in terms of the three certainties in life. You're going to always have bills, you're going to always pay taxes, and one day you will die. Now, what we need to remember in all of this is the time you have alive is limited, whereas people that collect bills and taxes, the authorities behind that, they have an infinite timeline. They will always outlive you. Now, why do I bring this up? Well, because in life, there's two things you need to worry about when it comes to money. Assets, which is anything that puts money in your pocket, and liabilities, which is anything that takes money out of your pocket. Now, I know that seems like a very simple thing to have to explain, but you'd be amazed how people can confuse the two, or rather, what we're going to show you in this video is how liabilities can become assets. So here's the normal ebb and flow of life. You have bills, right? We know they have an infinite timeline. So what do you have? You have some time. Hopefully you sell your time to earn some money. Your money pays your bills. Your money then gets taxed. And if there's anything left over, you try to create other assets. In other words, savings, property, investments, that type of stuff. But again, you get taxed here as well. Rinse and repeat is the formula. And now what I want to talk about is looking at different ways you can structure your earned income. There's basically three ways that money flows into your life if you're working and selling your time. There's PAYE and PAYG, which is pay as you earn, pay as you go, sole tradership, or operating a limited company. Now, as it pertains to the way we're going to go forward, think of cash flow through each of these in the form of a tap or multiple taps. If you're here, you got basically one tap. With a sole tradership, you have multiple taps. With a limited company setup, you have, well, we'll get into it, quite a lot of options. So let's start with the simple one. Now, all of the advice I'm about to give is more or less based on the UK system, but I think in other countries it's very similar. But again, ask your accountant. So there's someone out there who's willing to employ you and pay you for your time. You then earn a salary. That salary flows as follows. Look at the time span of a year. Now, in different countries, paychecks arrive at different times, but I'm going to use the UK model, which is you get a paycheck once a month, which means you get 12 paychecks a year. I think when I was in Canada, I used to get 2 paychecks a month, 24 paychecks a year, but it doesn't matter. Just know that you get a paycheck. Now, your paycheck flows as follows. The taxman takes your money at source, meaning the cash is out of your pocket before it lands in your bank account. Then what remains after you've been taxed is your take-home income, with which you use to pay your bills. Your bills are shelter, transport, energy, clothes, holidays, whatever takes money out of your pocket. And that is the pay-as-you-go and pay-as-you-earn model. Now, if you have anything left over after you've paid your bills, you can use it to create other assets like savings and investments and whatnot. The only way to reduce your tax burden in this scenario is to pay into a pension contribution. Now, there's several different schemes, and again, seek different advice. But in essence, if you sign up to pay into your pension off your paycheck, normally that means you pay less tax because you're putting it through a different vehicle. So that's pay as you earn. And the only other way to save on taxes is to make charitable donations, which is always wonderful because they're usually tax write-offs. But remember, that's not generating an asset in the typical financial sense. It might be saving someone's life or building a well in Africa, which is wonderful, but for the purposes of this discussion, it's not generating an asset. And it's not even it's not a liability either, so it's kind of caught in no man's land. Now, imagine for a moment you don't have one person wishing to pay for your time full-time. You might have a few. You might be in the gig economy. You might hustle. And you go out and you collect money under your own name. That's called a sole trader. So you're self-employed and you have different clients. Now, what's different here is these clients don't pay you a salary. They pay you what's called revenue. And the way that works is that instead of a paycheck, you're sending out invoices, provided you're being legit, and your clients are paying those invoices. Now, what's different here is they don't pay you regularly. They might pay you late. They might pay you early. So invoicing is different than a paycheck, which lands in your bank account regularly every month. Now, you have to pay your bills, right? But here's what's different about being a sole trader. Some of your bills can be called business expenses. So, for example, transport, or if you have to buy a laptop, or you need to buy something that allows you to execute your work, execute what you are being paid to do. That can become a business expense. And this is what's different. You can lessen your bills at this level before taxation by putting through expenses, allowable expenses that you're allowed to take as a business person. Then you can contribute to your pension. And then what's left over after the money has flowed through these two items is what you call your net revenue. Again, not your net income, your net revenue. Because what then ends up happening is as a sole trader, you do your taxes once a year. Now, what's the advantage to this? Well, it just means you don't get your tax bill for 12 months, and then you can pay it in the next year. So in other words, depending on how much your clients pay you throughout the year, you can keep more money, your sole trader bank account, before having to go and declare everything to the taxman, which is called an annual self-assessment. So you have to tell them. It's a bit like playing poker. They don't know your cards until you lay them down. So what remains, if you hold your taxes back and pay them on time, is what you call your net income, which allows you to then pay bills and create assets. But the key thing to note here is you can see there's more levels of flow that reduce your taxable income as a sole trader. But the risks are you may or may not get paid regularly, or you may have to cash flow yourself depending on how much work you generate or don't. The third option is if you set up a limited liability company. It's called different things in different regions, but basically limited liability company means it's a separate entity. So to be clear, it's not you, it's a company that serves your clients of which you control. That's very important. Now, similar to being a sole trader, a limited company operates in that you generate revenue. So again, if we look at a 12-month timeline, your company is generating invoices that you send to clients to be paid. Now, here's what's different. As a director of a limited company, you can pay yourself a salary. So you can be employed by the company you own. If you decide that the company can pay you a salary, it's usually a very small salary. It's enough that you're not taxed on it. So again, before the taxman comes to see you, you have a salary that comes in and it can be regular. And then from your bills, you can look at pulling out expenses. You can make pension contributions. And just to note, with a limited company versus a sole trader, typically you have a lot more business expenses that you can claim. And then lastly, after all of this has come out from your revenue, you then have what they call your net revenue, which is what's left over after all these things are done. And again, you have to pay corporation tax annually. So once that's paid, you then have an option called dividends. Now, what you'll see here is this paycheck is paying you as an employee of the company. But now, when we get to this point, you go forward as a director of the company. And as a director of the company, you're allowed to take out what's called dividends. So that's what's left over after all of these things have cleared. And with those dividends comes dividend tax. But between corporation tax and dividend tax, generally speaking, you can keep a lot more money in the company. So it's more tax efficient. And with your dividends and your salary, you can pay your bills. But remember, maybe a lot of your bills can be offset as business expenses, depending on the advice you seek. Then, with your paycheck and your dividends, you can contribute towards other assets, savings, and investments. Now, here's what's interesting. If you are married and both of you are either sole traders or not employed by one company, both of you can own the company together. So what you'll see here is we're now talking about directors with an S over the limited company servicing multiple clients. The system stays the same. There's invoices, and it doesn't matter who invoices. The company invoices for both of you, depending on what you're doing. And then what happens now is the flow completely changes because the invoices flow to both, and both parties, shareholders or directors within the company, can issue themselves paychecks, write off expenses, make pension contributions. And depending how the company's set up, if you're both directors, let's say with 50-50 share, you can both split dividends from the companies. But here's what's interesting about that. You can split the taxation. So in other words, if your company makes a certain amount of revenue, you can both claim tax relief on it. Again, speak to your accountant about how this works, but the short version is you have more ways to flow the money before it gets to the end of the year for taxation, whereupon the company would pay its corporation tax and you as people and as individuals would claim your shares or your dividends to be taxed as well. And then ultimately, if you do it right, between a married couple, you have way more income or way more revenue that you can use between you instead of giving a lot of it to the tax man. So, in brief, how do you want to manage your cash flow? Cash can come into your life, money can come into your life, and you can flow it as a paid employee, you can flow it as sole trader, or you can flow it through a limited company, and if you're married, a jointly owned limited company, all of which changes the way the money flows, the way the money is taxed, the way you pay your bills. All kinds of different options are available, and even beyond that, flowing money back into other assets such as pensions, savings, investments. So that is a high-level view of how money can be flowed. And the question you need to ask is, how often do you like to pay tax? So if you are an employee, it's every week or every month. It's basically on every paycheck. Whereas with sole traderships and limited companies, it's once a year. But there's more complexity because you have to do self-declaration, self-assessment. So it means you need to have kept all your records for the year, all your receipts. You have to know how to fill in tax forms, or frankly, pay an accountant to do it. It's worth every penny to do it professionally, in my opinion, and you can expense the accountant's fee as well. So that's another consideration is on how you want to do that. You can do more than one. It just gets very complex. And then another thought is, what legal protection in your life do you need? So imagine something happens on the job. If you are an employee and somebody wants to come after you, certainly they can come after your assets, meaning they can come after your home and your money and all kinds of stuff. So you are personally liable for people who pursue you in court, or hopefully your company is indemnified or has some form of insurance policy, meaning if somebody were to pursue an employee of the company, there's limitations around that. If you are a sole trader, it's similar in that somebody who might be angry at you or might want to come after you in court, they can come after your personal assets. So your house, your money, your car, they can come after that unless you have some kind of indemnity insurance, meaning that the insurance company will pick up the tab. However, as a limited company, you're flowing revenue through a limited company, the limited company takes the hit and the directors and shareholders of the company do not. So in other words, your company dies before you do. So think of it like a moat. You can put a moat around you so that if something goes wrong, people can't come after your personal assets. They have to come after a limited company, which, as the name suggests, has limited liability. Okay, here we are at the end. Thank you for watching. I hope this has been helpful to you. I do caveat again, I'm not a financial advisor or a lawyer. You need to seek that advice. This was just more to help you with a framework, or at least start to understand how money flows. Now, this chart you're looking at right here is a bit of a summary of everything. It should be self-explanatory if you've watched the video. And as I said, there's a link below if you want to look at this in your own time and at your own pace. So thanks very much for watching. Thank you guys for supporting SparkHub, and I hope this has been helpful to anyone out there that's managed to get this far in the video. Thank you.